Hello traders, welcome back to the Forex gig, and in today's video we're going to be talking about how to explore two important candlestick patterns, the hammer and the inverted hammer. Understanding this pattern can significantly enhance your trading decision, especially when identifying potential market reversals. By the end of this video, you will have a clear grasp on how to recognize this pattern, the key differences between this pattern, and how to effectively trade them. So make sure to watch until the end of this video to gain a valuable insight that could improve your trading decisions. So let's get started by understanding the hammer pattern. First of all, we'll talk about the hammer candlestick, and is a bullish reversal that typically forms during a downtrend. This pattern only forms during the downtrend. It has a distinct appearance resembling a T. This pattern consists of a small body located at the top of price range with a lower shadow that is at least twice the size of the body. This is usually little, and there are usually too little or no upper shadow, meaning the hammer has a little body, a long lower wick, and little to no upper shadow. The significance of the hammer lies in its ability to show buyers' strength. During the section, sellers push price lower, but buyers step in and push price back up near the opening level. As you can see, this is what it indicates. It also indicates that buyers are starting to gain control, which may lead to a potential reversal. So this is typically the hammer candlestick pattern. Now we have to understand the essentials of the inverted hammer candlestick. And the inverted hammer candlestick is another important candlestick pattern that also signals a potential reversal, but it appears during a downtrend. So the inverted hammer and both the hammer always reverse at a downtrend. They show a potential reversal, but they appear during a downtrend. This pattern looks like an upside T, as you can see from my screen. It features a small body at the bottom of price range with a long upper shadow. As we can see, it has a long upper shadow that is at least twice the body of the candle, and it has typically little or no lower shadow, as we can see from the examples over here. The inverted hammer indicates that buyers attempted to push price higher during the season, but sellers step in and push price back down. So this is typically what it means. It means that buyers were trying to move price higher during the section, while sellers stepped in and pushed the price back down. However, the fact that the price closed near its opening, as long as it closes near its opening, it suggests that selling pressure may be weakening. It suggests that selling pressure may be weakening, and this could signal a potential shift in momentum towards the buyers. So this is typically the example of the inverted hammer candlestick. Now, when trading the inverted hammer candlestick, it is crucial to always wait for confirmation as well. The same way you wait for a confirmation when trying to take the hammer candlestick, when taking the inverted hammer candlestick, you must also wait for a confirmation. Now, the confirmation is indeed telling you that buyers are taking control. A strong close above the inverted hammer candle body signifies the potential reversal. it assures you that yes, price is going to reverse. The same with the bullish, it's the same with the hammer candlestick, sorry. A strong closure above the hammer candlestick pattern assures us that the reversal is an assured one. Now let's look at some key differences between the hammer and the inverted hammer pattern. It is essential for us to know the key differences so that we would know how to trade them and how to apply them to our charts. Remember, both of them are both potential reversal signals, but they have distinct characteristics. The first characteristic is the appearance. The hammer has a small body at the top of price range. The small body is located at the top of price range, and it has a long lower shadow. It has a long lower shadow. This indicates that buyers are stepping in after the sellers had price push down. Price tried to push down, but buyers stepped up, carrying price to close above. While the inverted hammer features a small body. It features a small body at the bottom of price range. As we can see, is a small body at the bottom of price range with a long upper shadow. It has a long upper shadow, but this shows that buyers were trying to push price to the upside or trying to push price higher, but sellers came in and caused a resistance in price. This is typically what the inverted hammer candlestick is all about. That is one of the first key difference. I'm talking about the appearance. The second key difference is the market context. Market context is about the hammer, is a typical pattern in the hammer market context. We're talking about the pattern when it forms in a downtrend. Typically, the hammer forms during a downtrend, signaling a potential market reversal, a potential bullish market reversal. It suggests that buyers are gaining strength after a period of selling. So when we spot this in a downtrend, it simply means that buyers are trying to gain strength after series of downtrend. While the inverted hammer candlestick, its market content also appears in a downtrend but indicates that buyers' interest is starting to emerge. It reflects buyers attempting to push price upwards. In the downtrend, is attempting to push price upwards even if they were ultimately unsuccessful during this particular session. This is what it means. So it is more like a risky option, but it is a reversal pattern. Now we talk about the reliability of each of these patterns. The hammer is more reliable because it is considered to show immediate buying strength. A strong close above the hammer body often confirms the reversal. So once we see the candle, the hammer candle, and a strong next candle that closed above the candle is a strong confirmation that price is going to reverse to the upside. While for the inverse hammer candlestick, while it is still useful, the inverse hammer candlestick may be seen as a less reliable pattern because it requires further confirmation to ensure that buyers are indeed taking control. Now let's see how we can apply this to our charts. We'll see how we can apply this when trading. When trading the hammer and the inverted hammer, we have to have a clear strategy. It is essential to maximize our chances of success. So let's look at some tips that would help us in trading this pattern. We'll start from a tip to help us to trade the hammer, and this is a typical example of a hammer. When we see a hammer, it occurs during a downtrend. Let's not forget it occurs during a downtrend, and as we can see, the market is making a series of lower lows lower highs, lower lows, lower highs, lower low. So immediately we see our pattern, it signifies the market is trying to reverse. This is what it's all about. So first of all, we wait for the confirmation. When we wait for the confirmation, we look for a bullish candle in the next trading session. The confirmation is crucial because it shows us that market is really trying to move in that direction. So the confirmation is seeing a next bullish candle that closes above the hammer candlestick. The next thing we need to do is to check our volume. So adding my volume indicator simplifies it. It helps me to know that volume buyers are really coming in. The volatility of the market is really increasing, and as you can see, there's an increase in the volume bar at this area where we saw our hammer. So the next thing we should know about the hammer is where we would enter our trade, and where we should enter our trade is we would enter a long position above the next hammer candle. After we see the hammer candle, the candle that closes after the hammer candle should be our confirmation for a buy. This is where we would want to enter our long position. We enter our long position. Let's not forget our stop loss placement. Our stop loss placement should be below the hammer. It must be below the hammer. This helps to manage your risks in case markets do not move in your favor. And our profit target should be at a reasonable level. It can be a previous resistance level. This is a previous resistance level, which is a previous high in the market. This can be our area for take profit, or we can decide to go for a fixed take profit of 1:2 or 1:3, a fixed risk to reward ratio of 1:2 and 1:3, as the case may be. So this is typically an example of how we can take the hammer setup. Now let's see how we can take the inverse hammer pattern. And as we can see, I can spot an inverse hammer pattern in this area. This is an inverse hammer pattern. We start by looking for a similar case to the hammer. We have to wait for a confirmation. The confirmation would be a bullish candle that closes above the inverted hammer. The moment we see a bullish candle closing above the inverted hammer, it confirms that buyers are really taking control. We can also compare that to our volume, and as we can see in this area, we are showing that there were a lot of activities going on in price. Though it is not that strong, but we can see there is activities going on in price. We enter the moment we see the second candle close above the inverted hammer. We enter our trade in that area. Let's not forget our stop loss is important, and we put our stop loss just below the inverted hammer. This is to protect our position against unexpected market move. Then our take profit, we should set the take profit target to the nearest resistance. Setting it to the nearest resistance will give me a 1 to 7 risk to reward on this trade, or we can use a fixed risk to reward of 1:2 or 1:3. Let's look for another example of an inverted hammer candlestick. And as we can see, this is another example, and we can see it occurred during a downtrend. This is a typical downtrend when price was trying to reverse to the upside, and as we can see, we spotted our clear, this is the clear inverted hammer candlestick. This candlestick over here is a clear indication that price is about to reverse. The next thing we need to look for is our confirmation, and our confirmation is the next bullish candle closing above our hammer candlestick. And as we can see, our inverted hammer, as we can see the bullish confirmation after the inverted hammer candlestick. We will enter our trade after the closure of our confirmation putting our stop loss just below the inverted hammer. Then we ride this wave. We can take our profit in the next resistance area or the next swing low or swing high confirmation, or we can decide to take 1:2, 1:3 as the case may be. By implementing these strategies on both patterns, you can effectively capitalize on the potential market reversal and enhance your overall trading performance. Always remember that a good risk management and adapt and always remember to practice a good risk management and adapt your trading strategies based on the market condition. Alright traders, we have come to the end of this video. Today we explored the hammer and inverted hammer patterns, discussing their characteristics and differences. Discussing their characteristics and differences were really important so that we can take advantage of this pattern when we spot them in the live market. Remember, understanding this pattern can be significant because they enhance your trading decision and help you identify potential market reversal. So if you found this information valuable, please give this video a like and subscribe to the channel for more insights. Do not forget to turn on your notification bell so you wouldn't miss out on more trading updates. See you next time and happy trading.